Okay, guys, can we call it there? We're going to work our way through each of the groups and ask you to give us a quick sum up of the learning of that particular session. And team number one over here, we really just want you to tell us your findings from that session.
Hi, everyone. So our discussion actually jumped around to a bunch of different places, but it really focused on pulling data together from a wide variety of disparate sources to create dynamic analysis of behavior, essentially. So this actually was discussed in several different kind of divisions of the insurance life cycle. So one portion of it was about customer engagement, right? How can we use data to better engage with customers? Specifically, we talked about the idea of eliminating silos within a large insurance company like a Chubb, right? Different business units actually talking to each other to understand, not just what products customers were buying, but who are they, what's going on in their lives, and how can an insurance company engage with them to help mitigate their risk across everything going on in their life, not just their car insurance, their home insurance, et cetera, to build a deeper relationship in that respect. Furthermore, the idea of the fact that, using data that can be push from customers back to an insurance company can actually enable the insurance company to deliver a better level of service to them as well. The idea of the fact that, what if insurance companies gave customers incentives to install sensors in their homes, their cars, wherever, right? To actually, give this data back to the insurance company to enable insurance companies not just price insurance products to them based on historical modeling of pools of people, from all over the world, but rather build a dynamic risk profile for the consumer themselves, who they are, the behavior they take, et cetera. And the fact that, analysis of this behavior can lead to more real-time response to customer behavior, which isn't necessarily capable today on technology that exists. Something actually pretty interesting that, Gary came up with is the idea of, what if there was, a risk score for consumers, just like as if we all have credit scores, right? All are, getting a mortgage, credit cards, loans, et cetera. We have a credit score. What if there was a unified risk score for customers too? It's an interesting possibility. And Val, you want to dive into the captive pool?
The catch-all phrase is really to try and use predictive analytics to create differentiated pricing. So in other words, can you price the product for that individual consumer at the point that they need to make that purchase decision? So, and the example that I use is sort of like, go back to what happened in the financial crisis in the capital markets with sort of like a lot of these CDO products. There was this assumption that if you have a large enough pool, that the risk actually would diversify itself away. Without really understanding, okay, what's driving the 30 or 40,000 mortgages inside of that pool? So what if within insurance, a company could actually look at the individual risk at the individual level? Yes, companies do that to a certain extent. They'll ask you if you want to buy a life policy, what your age is. But there are a number of other factors that can drive the risk characteristic that would allow you to do better pricing, essentially.
Yeah, and we also talked about that using the analytics and the model that's actually created to help build a sort of a network effect for the insured. Because today the insurance companies, the insurance products are essentially commoditized. But what if we can use the analytics using the sensors that we have installed in our homes and help them improve their lifestyles? And so that as a result of it, the insurance companies really are helping them not in terms of offsetting the risks, but also helping them improving their lifestyles and making their home safer. And that will also turn around and helping the insurance companies to do a better model to predict for the reserve practices as well. So sort of going into the active risk management, risk mitigation, practices for the customers. So we talked about the claims analysis in terms of real-time claims analysis. Looking at the profiles of the claims, we can then utilize the data that's available to then help establish best practices, and helping the customers gain lower risk from that.
All of these are great. I'm just going to try to put a bow around this. There's a few things just to add. One is that as consumers, particularly millennials, are using more and more social media tools to essentially profile themselves, we thought about it. Is there a way for time to start aggregating data through what they're posting and the amount of things that they're sharing, and somehow, having that kind of add a little bit more or a different dimension to their risk profile. We talked also about how insurance is largely kind of a passive decision. It's not, unfortunately, not on the same level as, when you meet your accountant or financial planner, so you're kind of getting a financial health check every year. So one of the things as a consequence of that is that quite often there are gaps in your risk profile as your lifestyle changes over time. So what you might buy, as an MBA grad in terms of a basic auto policy in 5 or 10 years, when you have a family, you have a home, you go on different types of trips, you don't necessarily think about going to your agent or whatever to have that assessment. So what we thought about is, as you begin to have these sort of dynamic profiles being built, whether it be through smart sensors on the home or whatever the case may be, the insurance company begins to, and social media, et cetera, begins to actually have a very proactive profile of you, not necessarily where you are today, but where you might be in 3 or 5 years, and can match that against your coverages to be able to proactively come back to you and say, you actually have a significant gap in your policy based upon your lifestyle. So it's a very important value add dimension that insurance companies would have.
So this is not financial planning, this is insurance planning.
Yeah, and it comes back to kind of the risk score that we had as kind of an aggregated thing to be able to say, okay, you are buying X in terms of coverages, but knowing enough about you from the sensory devices or the wearables, whatever, about you as a consumer. And also, because we are not silent anymore in our organization, we know that you actually own a business and have these types of coverages in your business. So your whole risk profile suggests that based upon what you're currently buying, either you're underinsured or perhaps overinsured in certain areas. So it's, I guess what we're trying to get at is not only dynamic risk profiling, but having a better and tighter fit between what risks you're looking to mitigate and who you are as an individual or as a business, and realizing that changes over time.
Right. Yeah, I guess if you sort of look at the field of behavioral economics, which for the most part right now applies to sort of retail investing products, is essentially trying to bring some of that same science to insurance decision making on the part of consumer. And then based on that, creating a profile so that the type of insurance coverage that's offered is really tailored to that individual, creating that differentiated pricing that I talked about before.
This is mass personalization for insurance, is what you're talking about, rather than a commoditized product, the one you just mentioned.
The other thing, too, we also thought that this, another derivative of this that this suggests is being able to it's kind of like the Airbnb model for insurance, buying insurance on the go as you need it. For a particular, either, let's say you're taking your family of 4 to Mexico and you're going to these resorts and doing these kinds of activities, right? To being able to buy a pod or a package of insurance for a particular need. So there's other, it's not just the traditional policy, there's other kind of spin-offs in terms of insurance products as you get this dynamic profile.
Okay, last word from Matt.
I was just going to say, and the idea that maybe this could even create a new type of customer for an insurance company. Maybe you don't buy policies, maybe you subscribe to an insurance company. You pay $50 a month as a baseline, and then and that enables you to pay as you go. So a whole different way of engaging with the insurance industry as a whole, hypothetically.
Thank you very much, guys. That was a very, very good sum up. Thank you. Thanks. Very, very good. Let's move over to group number 2. Take it away.
Indeed. Our approach was actually to look at the disruption in the insurance industry. If you take the example of the flow chart here, you can see that this was actually done by engineers and technical people. I don't particularly have too much knowledge about insurance myself. But what we did is that our main filter was to see how we can use big data to filter history, that is the present history, to record and records of everything that has been gathered by the big data, the data analysis or the evolution of that as well. And what we identified were essentially 4 sectors: homeowners, life insurance, travel, and car, each of which actually carry certain risk. With respect to the homeowners, we decided to create 2 extra filters here where we talked about the specifics of only truth to this sector and all of the aggregated possible outcomes of this model. For the homeowners, we'd realized that after analyzing the data we can see that the weather predictions will continue to improve because of big data. That obviously will have an impact in the rate. Either it will come down or it will go up. And more aggressive segmentation of the data towards the best or the worst customers. Or in this case, for the homeowners, will be the best or the worst areas that have been impacted by weather. With respect to the life insurance, the risk that we brainstorm a bit, where the wearables and health, the impact of which, by gathering this information and understanding the information that is being gathered by those devices that you wear, could bring about medical records that are going to be digitized, and then this will chart everything as it's collected. Then you have basically its aggregated data. We sample the data, we analyze it, and then we'll see how this will impact, of course, the life insurance of the policy holder. If the lifestyle of this person is quite risky, of course, we do see how this could impact, of course, the rate, and it will impact, of course, also the segmentation and the aggregation to determine whether or not do we have a best or worst customer. With respect to the traveling, the risk impacting there specifically, we discussed the issue of the car, in that the debate currently in this specific sector is the power of the data versus the randomizer risk that comes with the collection of this data with respect to how the travel, it's impacted by the person that is traveling or the person that is actually holding that specific, policy. I think that they brought about in terms of the statistical analysis of this, the engineer there mentioned the black swamp example. And that's I believe it's a market phrase which I was educated on it, and is that obviously swamps are basically white, so the rate to which you're going to find one that is actually black it's where you could actually draw the analysis of randomizing the risk, or basically the power of the data as it relates to the specific issues of the traveling. Then we identified again the issue of rate and the issue of aggregating the data and the segmentation of which will determine whether or not it's a good area to be traveled, what's the best area with the least amount of risk, versus a worst area that is probably, of course, you don't want to travel to Ukraine because your chances are you might actually get blown. So that kind of mitigation was the analysis here. We discussed the other sector, the car, and we dealt with various different possibilities of specific analysis of the data of the car, meaning the tracking of the vehicle, and I believe will be in the area of artificial intelligence. How could the vehicle itself would determine the age and the risk impact of profile of the driver? Would the car know that is grandma driving the car, or if it's the teenager driving the car versus just the actual owner of the vehicle? And how that could actually be analyzed, and could, once again, it would impact then the rate, and it would impact, of course, the way in which we're going to aggressively segment the information, and the way in which we're going to make that our determination in the scale, whether if it's best to our interest to cover it or not to our interest to cover it. And finally, then, of course, with respect to the car, we discussed the various possibilities of creating algorithms for the Department of Motor Vehicle data with respect to the car history, and the driver. The insurance disruptor will vary from vehicle to person, the history of the car and the individual driving record. The insurance disruption will also segment the price disrupted, and this will obviously, I think that the point here was that it will, by segmented, it will then disrupt the industry, because then you're going to create various different price sectors for each of the different models that we discussed here. The Google car is one example. What risk factors could be associated with having a vehicle being driven by artificial intelligence, GPS devices, a server, etc. And most importantly then, of course, we go back into this whole issue with how the rates will come down or will go up depending on the risk factor. Again, also big data, more aggressive segmentation to make our determination, what scales are going to be used. And how is that? This is going to impact actually the bottom line of the industry, because the bottom line is basically how much money will be spent and how much money will be coming in. Then finally we discussed in this sector here how we're going to clean up the data, the feedbacks that we get from this data, the possibilities of probably implementing maybe rewards programs to those who are exhibiting good behavior, and the interaction between the insurer and that is the individual, which is a niche between the car and the individual. I believe that was where we wanted to discuss there, correct? So that we gave two examples, the life plus the car itself, or the life plus the weather. So there's also many different sectors that could be actually implemented in this algorithm, and our model was in response to what we felt were the disruptors.
Okay, well, thank you very much.
Thank you.
Who wants to lead us on team 3? John? We'll move some cameras over to you, John.
I think we took a little different, and there was not an artist amongst us, I believe. So the observation we spent, a lot of time talking about was sort of the notion that, at least in the established legacy company side of the insurance business, you have this tendency to have very, very integrated delivery chains, sort of the classic Porter, why companies have advantage in a marketplace model. And that, the risk that we're seeing, and big data, I think, is a big driver of this, is that it enables players to come in that may require little or no capital, or they may be able to quickly create a synthetic or real capital base and enter into the business and start to slice off very discrete pieces of what goes on and charge other players basically a rent for that. So that, today we have an advantage in the underwriting black box in most companies if you're not wholly dependent on ISO loss cost data. So you can construct that, but increasingly you'll see proxies emerge or aggregators of data emerge that you can basically start to construct your own underwriting or pricing models that aren't dependent on having all of this lost claims data. I was actually talking to some guys that are trying to put together effectively an auto telematics data business so that companies that don't have an existing one can basically buy in, rent that data, match their own people against it to see how their own folks match up against the people that are in there to start to build their own models, absent having what Progressive has built by starting in that, back in 1998. But that, across claims, the sales and marketing, the different systems that are used for CRM, increasingly players can come in and start to pull those pieces apart. And eventually you get to a place where you could basically line up an entirely virtual company by simply chaining this stuff together. And then where do the traditional players like us end up? We're basically potentially just a big pool of dumb capital who, we have to pay other people for things. I think right now with a specialty bent, Chubb is well positioned to kind of defend against that, but you have to break down a lot of behaviors. And, we talked a good bit about behavioral issues that you have where, you have very set ways, ingrained heuristics about how people do things. And analytics and data, in a lot of ways, are a threat to those established ways of doing business or thinking about risk or analyzing or selecting. And particularly, my colleague, Jerry Myers, talked about doing distribution analytics. And, we said we really know very little about what actually, from a data standpoint, defines a great agent from a mediocre agent from a poor agent. We know by financial results, but we don't really understand a lot about the underlying data and what they're doing right or wrong, or how you would replicate that experience or how you would predict that outcome across, another set of your distribution. So, they're just, again, there are all these little places where we're increasingly seeing players come in and pull a slice out and start to do that particular function. And at a certain point, we went back to the old Army War College, amplitude of signal versus number of options chart. And if you're here, when the amplitude is relatively low but the optionality is high, you have a good chance of coming up with a solution. You get out to the crossover point, and you're basically waiting for death because you're simply going to be out of business at some point because your options are going to drop to zero. So again, it was a little bit, it was less about getting into, specific products and the like, and more, talking about how do you meet or deal with those risks as they come up. How do you start to engage these companies, perhaps buy, license? The insurance industry has traditionally not done what pharma has done, which is, you find a promising startup company, they've got a great research pipeline, or they've built some really interesting devices, and you buy them and you subsume them in. We're not, our industry has traditionally not been good at that. And I think unless we start to build that capability, then we're going to be highly vulnerable to these changes because we can't do it all internally.
That's very, very interesting, John. I think banks have been through this already, and they've started off in this position. They've kind of learned how to engage now with the innovators more. So they brought them in. So a good example is in London, Barclays has set up an accelerator to build a development community around their own API. So they've kind of learned how to do that. And I think maybe insurance is just about 3 years back from that, or banking is maybe 2 or 3 years ahead. So insurers are going to have to learn how to engage with these new technologies one way or another.
Yeah, I mean, Jerry and I have been up to Fidelity has a great technology and research center in Boston, across the street from South Station. And, they're doing this all day, every day with a building full of people, trying to figure out how, it's a fantastic facility. But it's exactly that, everything from little labs where you're trying to manipulate things to, testing eye movement on screens but that's how they're doing it. The insurance industry, other than, Progressive, a few companies that are selling massive amounts of a single product, the insurance industry is not doing much of that we can detect. The single product companies are, the multi-line intermediated carriers are still trying to make sense of what's happening.
Okay, that's very interesting insight. Thank you very much, John. Thank you. Okay, so what we'll do now is we'll take a quick break, and then we're going to do a second scenario.